The October CPI just shocked the market. Hi, everyone, and welcome to another episode of Insights brought to you by Ainsley Bullion and the Gold and Silver Standard. Today, we welcome back Brenko, who's been looking into the big miss from the numbers last night, our time, and what they mean for the markets more generally. How are you going today, Brenko?
Good, good. Keen to talk about today's topic about CPI and how it just kind of shocked a lot of the markets this morning and a lot of interesting takeaways from it, for
Yeah,
sure.
there are a lot of interesting takeaways, and it certainly was a shock. We saw the markets quite a bit of movement off that surprise because they were expecting inflation to be worse, and this is US inflation we're talking about than it was. But let's start off with a bit of a quick summary of what actually happened there. So, how did the CPI actually perform relative to what was expected?
Yeah, so you had some pretty bullish outcomes coming in for CPI. Um, the core and headline, sorry, the core was supposed to stay steady and the headline was supposed to drop from 3.7 to 3.33. And it actually dropped even more. So
Mm-hmm.
the big takeaway is that the numbers came in much better than expected. And basically, the market obviously reacted very positively. The core CPI is now as its lowest it's been in 2 years, and things are looking quite positive on the surface. So yeah, it's just overall pretty good news, I would say, and I would like to get into some of the implications as well as it pertains to homeowners. And I think yeah, it's generally a good day.
Yeah, and it's been a tricky one because CPI has been sort of difficult one to read because we've had like we know that it had peaked earlier, but then how fast it was coming down. There's been a lot of speculation around potentially a bottom that then bounces back up again and we get a second spike. There's so much conversation around this over such a long time that it almost wears you down, I suppose. So it was interesting to watch how the markets actually did react. What would you um, pull away from that? Because there were some areas that showed particular strength. What was it that caught your attention with how the market actually responded to what numbers we did receive?
Yeah, so I think we'll put up a graph here, but overall, 95% of the companies in the S&P today were in the green, and the index as a whole was up 2%. And then there are certain sectors within that that show particular strength that are interesting to look at. So, to no surprise, consumer discretionary. So, obviously, if inflation goes down, generally it means people have more discretionary income to spend on things they don't, they might not necessarily need, but do want. So, very positive for that area. And then financials and tech as well were up significantly. So something to continue to monitor is just how these sectors continue to react. Could this be a situation where um, everything kind of, particularly that consumer discretionary area, everything kind of upon this news explodes and now we kind of slowly retrace? Or is this going to be a continued move in these sectors where people kind of have this income and they can put it into these sectors and they continue to grow? So I
Mm.
think it's very positive for consumer discretionary, financials, and tech as well.
So that was looking specifically at the areas that benefited in terms of the stock market, particularly US stuff. But let's bring it back to Australia. Do you think that there's a correlation going on here between what happens with those US rates? I mean, I expect there is, and what we can expect to see here in Australia, because we had that rate rise recently. I tended to think that that was, I wasn't necessarily expecting that because I was expecting that potentially in the US we would see um, rates continue to moderate and the pressure continue to come off them needing to raise. So, how do you interpret that? What's your take on the impact for us here in Australia?
Yeah, this is something I want to dig into a bit more because I think it's not as simple as, yes, we did follow US rates, but the timeline of our rate rises has been very different. So, for example, we had the one in November that was kind of a bit of a surprise. So, even though this is good news in general for Australian homeowners, it makes a rate decline more likely because we started our rate rises later than kind of the rest of the West. And we've kind of shown that we've continued to do them. In my opinion, the impact of those rate rises are going to be a bit later to kind of show in the data than in the
Mm.
US. So it's not going to be as seamless as, oh, US is up, this is great, we're going to start going down now. We could have a little bit of a period of continuation or at least stagnation, and then eventually, like the US, the data sort of the rate rises start to play out in the data. So I'll get your opinion on that, but overall, I would say a quick summary of that is positive for Australian homeowners, but not kind of, it's not perfect. There still is a bit of a
Yeah,
difference.
we're not necessarily out of the woods yet, but you can see a potential that it all potentially has peaked. I mean, that's certainly what I've been looking at. I tend to look at the bond yields to get a little bit of guidance as well in the US, and we've seen those. There was a lot of risk, and we talked about this in insights over the last couple of weeks, that those bond yields could spike higher because there's all this debt that still needs to come and be refinanced, and that risk hasn't gone yet. Alex was talking about this yesterday as well, that in her mind, we might see the rates actually fall, but the bond yields still stay high, which seems a little bit counterintuitive. But when you consider how much debt needs to be refinanced, kind of makes sense. So that it's probably more complicated than usual because there's a lot of factors at play all at once. So yeah, maybe not crystal clear, but I tend to agree with you that I would look at it with a little bit of hope that at least we're at the end of that raising cycle, even if we're not rapidly cutting from here.
Yeah.
But there was a few specifically people who didn't agree. There were some dissenting voices in the committee. So is there any validity to what they had to say relative to what we've just discussed there?
Yeah, I just wanted to bring up some of these ideas by some analysts. One guy in particular, who's the global head of currency strategy at BBH, was just saying, like, don't hang up the mission accomplished banner yet. This isn't actually as good of a CPI as it says. For example, like food and beverages were up 0.3%, housing was up 0.3%. And like, I guess the overall point was the market sees what it wants to see. And furthermore, as we kind of discussed last week, these numbers, maybe aren't as fudgeable as the BOS numbers, which, as we discussed, the past 9 were revised down. So that was a very clear, let's get the headline out there of positivity and then revise them back. With the CPI, it might not be as easily kind of fudgeable or like manipulatable. But, this data, still, there are potential problems with it. I mean, one kind of issue I have is they try and give you CPI that doesn't include like food and energy, and then one that does. I mean, I think that it would make sense to just provide the one that is a catch-all, because food and energy is pretty important to live, and people do spend their money on it, a large portion of their money. So just things like that, basically these analysts are saying, let's just take a step back and see if this continues, because the data is, not perfect.
And that's a really good point, because it's undeniable that there's manipulation going on in that labor, in those labor statistics that we talked about last week. Like the fact that you just have month after month the data printed and then massive revisions. That's ridiculous.
200,000 jobs revision.
Yeah, like absolutely ridiculous. But I suppose the difference with the you could argue it's still manipulated, but the difference with the CPI data is they manipulate it by just creating different baskets and different definitions of what the CPI is. So you got, the headline CPI, you've got core CPI, super core CPI, where they just keep chopping things out to get the result that they want to get, which to your point makes it completely useless data. Like if you just go pick and choose what you listen to. I mean, I tend to use the Trueflation data, which is just a site that sort of records inflation data in real time. And I find that useful because at least they're consistent. Really, it doesn't matter necessarily what you're using. You just need something that isn't constantly changing so that you can actually measure over time what's happening. And I thought that Trueflation data for me was quite good, because it had been indicating for a little while that it wasn't spiking up again. So I wasn't necessarily expecting that second big wave that a lot of people have been expecting. But yeah, it's really hard when you don't have really consistent data over a long time period, because even the CPI data has not remained consistent. For the methodology has not remained consistent for a long time. So it makes it really hard to compare.
Maybe we can put a link as well for the Trueflation data in the description or something, where people can have a look. I think it could be interesting, to get a different idea of what's going on. That could be something to follow, especially if, like what you're saying, it kind of predicted these outcomes. Maybe it could.
Well, you were just consistently seeing that there wasn't that other spike coming. It's still sitting high. It was still sort of sitting over, over that 2%, but it was lower than what the headline number was saying. So, and they didn't chop stuff out. That's what I liked about it. To your point before, they weren't just chopping out the things that they didn't want in there, like energy and food, the things that we, we can't live without.
Yeah, at the end of the day, probably, unlike a lot of these, like the BLS, for example, I don't think the Truflation guys would have any stake in the matter of what the outcome of their data is, unlike a lot of these other
exactly
entities. So,
and that's an interesting sort of side point. I'm just thinking about as we're discussing it that there is some benefit to having some independent data as well, which is what that's attempting to do. Because when you're relying on data from government entities, there seems to be, I mean, you'd like to think it's not operating this way, but there seems to be the opportunity for political interests to come into the data, and that's not what should be happening.
Yeah, 100% with that.
Yeah. All right. Well, thank you so much for that analysis today, Branko. It's been good to dig into that CPI data, and it'll be interesting to see what happens next, whether that's an anomaly and whether we do get this spike that a lot of people have been predicting still ahead, or whether this is a sign of things to come, that maybe it is conquered, even though that quote sort of said, don't hang up the banner of mission accomplished just yet. So it'll be interesting to see what happens. But thank you for that.
No worries. Thanks for having me on.
And thanks everyone for watching. Remember, if you have any questions or comments, reach out on those social platforms. That's us for today. We'll be back with Sam tomorrow to discuss all things markets and metals. Until then, have a great rest of the day, everyone.